Hello students and welcome to the lecture. So students, as we know that in the previous lecture we had started the financial knowledge and we were covering the banking awareness. Okay. So basically in this lecture we are going to cover with the same topic, banking awareness, but with the different topic. Okay. In the previous lecture we had learned about the introduction of the banking awareness. We have covered their importance in the examination. So basically in this lecture of the financial knowledge, banking awareness, we are going to start with the banking history. Okay, in the field of India. All right, like whatever we are seeing today, whatever the banks we are seeing today, whatever the economy, or you can say the banking economy we are seeing today, how all these things came true, what was the procedure behind it, all the things we are going to cover in this lecture. All right, so let's start. So basically the banking history, or you can say the history of banking in India, is an important topic for the competitive exams, especially those that assess candidates' knowledge of the banking and the financial sectors in the country. All right, as we had discussed in the previous lecture, like the banking section is one of the important part for the examination point of view, and banking history is an important part of the banking section. All right, so automatically this become an important topic. All right, understanding the evolution of banking in India helps candidates grasp the context and significance of various banking reforms and development over the time. All right, so now we have the early banking era. Okay, but before starting of this, let me tell you one thing. It is how the bank works. How the bank works. Okay, it is just a little bit introduction about the bank and their function before we start the actual topic. All right, so if I'm talking about you, you are an individual, okay, who having excess of money. It means that you earn rupees 100, you only need rupees 50 for all your needs and monthly expenses, and then you have rupees 50 as excess or saving. All right, so what to do with these rupees 50? Generally what we do, we deposit this amount with bank, mainly for two reasons. The first is that the security. If your amount deposited with the bank, then you don't have to worry about the amount. Okay, second is the interest you received. Okay, like if you are using the bank account, and if any of your family member using the bank account, then you are aware about it, that if you submitted some rupees, like if you submitted rupees 50 in your bank account, then you are entitled to get interest from bank, right? You are entitled to get the interest from the bank, which is might be any interest rate. It is vary from bank to bank. Suppose in the XYZ bank where you deposit your 50 rupees, you are getting 1.2% as an interest rate, which means that 50 into 1.2 divided by 100 is 0.6 is the 1.2% you will get as the interest. All right, now the question is, why the bank keep your money with itself? With it, and why they pay interest? And the second question is, how do they earn from it? These are the two main questions we should analyze before we move forward. First is that why the bank keeps your money. Okay. And second is, how do they earn from your money? Okay. So let's understand them. So the first thing, like you deposit rupees 50 in the bank account. There are so many people who deposited their money in the bank account. Like suppose bank has a deposit of rupees 10 lakhs from various people. Alright. In this case, the people who deposited their money, all of them are going to withdraw their money? Answer is no. Suppose this 10 lakh belongs to the 100 people who deposited their money into the bank account. Are they 100 to 100 going to withdraw it? No. Maybe only 20 withdraw the money, 10 withdraw the money, or whatso number. Okay. But entire 100 people will not withdraw the money from the bank account. Okay. This is the first case. Now, what happened? This 10 lakhs, which is kept by the bank under the security, and even it is entitled to pay you the interest. Suppose 4% interest rate they are paying you. So it's a liability for the bank. So why the bank is doing this? Because the person who requires a loan from the banks, there are two types of persons. First is the depositors who deposit their money into the bank, and the bank is responsible to pay their money. And then second persons are the debtors, debtors who took the loan from the bank and required to pay the money back to the bank. Alright. So basically the deposit which is kept by the bank with itself is going to be used for the loan procedure. Okay. After deducting CRR, which stands for the cash reserve ratio. Okay. Thereafter SLR, which is known as the statutory liquidity ratio. All right. And then as per the net demand and liability of the bank, which means that everyday withdrawal and what is the flow of customers who withdraw their money. After keeping all these things in mind, the bank will get out certain amount. Suppose 6 lakhs has been selected by the bank as a amount of which the loan will granted. All right. So how the loan is going to send a income to the bank? Because whenever the loans granted from the bank, is the bank granted the loan free of cost? Is it? No. Bank always charge some interest from the customer who is taking the loan. Suppose 8% is the interest chargeable on the loan which is granted by the bank. All right. So how much interest bank paying you? 4%. 4%. How much they are earning? 8%. It means remaining 4% is the profit of the bank, right? And this is also the earning of the bank. So that's why bank keep your money with itself. That's why it offers you the interest rate so that you keep your money with itself. Then they will use your money for the loans process. They earn the money from the loans. That's how the banks work. And remember one thing, let me tell you one thing very straight. No one is more greedy than banks. It's maybe the controversial, but it's a very, very straightforward statement that no one is more greedy than the banks. Because banks wants to grant the loans, they will earn a heavy interest on them. All right. So this is the basic functioning of the banks. Okay. They give you interest, then take your money as a loan and get interest. So now come back to the topic. So basically the concept of banking, like this one, which I have told you, dates back to the ancient times with evidence of indigenous banking practices found in texts like the Arthashastra and the Manusmritis. So this kind of practice, which we experience today, not this kind of developed, but the base of this kind of activities are date back to the ancient times. All right. And if we talk about the more specific time period, then it is the Vedic period. In the Vedic period, there is a mention of Yujishri practice. Now you will ask me, what is a Yujishri practice? It is also famously known as the predatory loans. Now what does this mean? It means that, let me give you an example. If you have watched old Bollywood movies, mainly 1970s and 80s era, okay, you must have seen that there is a landlord, or we call it zamindar. Okay, and these landlords used to give money to people, or you can say, or needy people. Okay, and this amount is not a huge amount, but somehow the person who took the loan not able to pay it back. Okay, however, the amount is not so big, but he is not able to pay it back, which means that he got exploited, by zamindar. And then you have seen the movies that the zamindar often visited the person's home with his goons, okay, and then he asked to leave the home as soon as possible, and various things had been portrayed in the movies. Why I told you this? Because I'm trying to tell you what do you mean by the predatory loans and why these loans are called unethicals. Okay, so during the Vedic time period, actually what happened? The wealthy peoples, and the poor peoples. So the wealthy peoples having the loan and the poor people are in the need of the money. Okay, so that's why what happened? They oftenly reached the wealthy people and took the loan from them. The loan was of the minimum amount or the small amount, you can say, but main problem was the interest rate. Because the interest rate charged by the wealthy people were illogical and harsh for the borrower. Okay, just take an example. Suppose if you are in need, okay, and then you ask me to grant you rupees 10 as a loan. Now you are not able to having the rupees 10. That's why you're asking me for the loan. Okay, I said okay, I will give you the loan, but at interest rate of 70%. Just an example. This is just an example of the unreasonable interest rate charged by the zamindars. 70% interest rate per month. Okay, so you are required to pay this amount after 6 months. Okay, now there are two types of interest: simple interest and the compound interest. You will have a proper understanding of simple and compound interest in the math section. I'm just giving you the overview. Simple interest is basically charge on the principal. All right. Compound interest is basically charge on the principal as well as on interest. Okay. Just take an example of the both so that you can have a better understanding. Suppose for rupees 10, the simple interest formula is P into R into T upon 100. P means principal, R means rate of the interest, T means the time period, and 100 is 100. So in this case, your principal is 10, rate is 70%, time period is 6 months, and 100 is 100. 7 6 is 42. It means that you are required to pay the 42 rupees as a interest when you will repay this amount. So 10 plus 42. What did you borrow? Rupees 10, but you have to pay me back rupees 52. Now this amount is bigger than the amount you borrowed. All right. It's just a simple interest. But the borrowing was not that easy. Okay. They had other exploitations also. And generally it was done on the compound interest. Okay. So let's have a discussion on the compound interest. First month, second month, third month. Okay. At first month, rupees 10 you borrowed. 70% on 10 is rupees 7. Total amount becomes 17. All right. In next month, the interest will charge on the rupees 70 plus on interest 7. So the 10% of 17 is 1.7 and 10% of 7 is 0.7. So the amount become 2.4 and 19.4. All right. Thereafter 19.4 plus 1.7 plus the interest charge on the interest. So the 10% of 19.4 is basically 1.94 plus the interest charge on 1.7. 007. So that's how the process will goes on. Now you can see in just 1 month, your amount becomes 17, in second month it's become 20, in third month become this and that. The amount will go larger and larger. All right. That's the main problem with the usury loans. And that's why they are known as the predatory loans. Because these loans granted with the intention to capture the borrower's property. Because you only borrowed rupees 10 from me, but now I am asking you rupees 52 to pay me back, which is higher than the amount you had taken, and you are not able to pay 52 because you were not able to have rupees 10. In this scenario, what I will do? Either I will make you my slave or take your property. Okay. That kind of practice was in the Vedic time. All right. And this got prohibited in independent India by the Usurious Loans Act 1918. From the Vedic period till 1918, this kind of practice grew. And then finally in the 1918, this kind of practice was banned by the Usurious Loans Act 1918. All right. After this, if we talk about the Mauryan period or the Arthashastra period, then basically in Mauryan period we had a mention of Adesh, which is the examples of bills of exchange. Now, what is the meaning of bills of exchange? Let's have a discussion. Suppose you are the person who want to buy something. Okay, I am the person who is the seller. All right. Now, in this scenario, suppose you required a thing for rupees 1 lakh, but you do not have amount of rupees 1 lakh. You come to me and ask me to give you the goods worth rupees 1 lakh, but you do not have amount. So you promised me, suppose you met me on 1st April and then you promised me on 10th of May, you will pay me the amount. All right. This is basically the time period. Now, how I will claim you to pay me the amount by 10 May? What should be the procedure? So this kind of condition is known as the bills of exchange. All right. So in the bills of exchange, you can say and promising instrument, or you can say it's basically a bill or financial instrument carries an order to pay certain amount by the due time. All right. I will make you the bill, which will carry the date of purchase, on which date you purchase, and the day of payment, on which date you have to pay me. All right. And then you will get a BP, which means the bills payable. And I will get the BR, which means bills receivable. Okay. So the person who having the BP is basically the responsible one who need to pay the amount. The person who having the BR is the responsible who will get the amount. All right. That's how the bills of exchange work. Clear? So now, the system of Adesh, which was mentioned in the Mauryan times, is basically the amount, or you can say it's basically the bills of exchange. Adesh means the order. Okay. So the person who had buy a thing carries the BP and he is ordered, or he got the Adesh to pay the person who having the BR the amount by the certain time period. All right. So that was the concept we had during the Mauryan time, which we also practice in the current scenarios. All right, let's move forward. So during the medieval period, various indigenous banking systems such as hundis and shroffs were prevalent in the different parts of country. So basically, if we talk about the medieval period, or more precisely after the Delhi Sultanate, or you can say the Mughal period, then we had a mention of a document called the Dastavej. Now, what do you mean by the Dastavej? What is the meaning of Dastavej? So basically, the Dastavej were the loan agreements control the details of giver and the borrower. All right. So these were basic the loan documents, and you can say Dastavej nowadays are known as the documents. Okay. So let's take an example. Suppose this is the bank named XYZ. Okay. And then you are the person When you go to the bank for loans, they will ask you to show the documents, right? This process is known as the documentation process. This is generally done to check out whether you are able to repay the loan you are asking for. Suppose literally I am the one, and if I am going to the bank and ask for rupees 10 crore loans, what do you think? Am I able to repay the 10 crores to the bank? Not. I'm not able. Okay. So how the bank will come to know about this kind of things? By the documentation. They will see your salary, your property, your credibility, and the process will go on further. All right. And also the loan document will be prepared by the bank when they drafted a loan for you. The loan document will carry each and every information of you. All right. What is the EMI you need to pay? What is the EMI you need to pay? Okay. What is the interest you need to pay? What is the time period of your loan? What are the other conditions of your loan? So these kind of things are the loan documents. Similar process was with the dastavejes of the Mughal period. So these were the loan agreements, contains the detail of the giver, like the person who granted rupees 10 to the borrower and the borrower who took rupees 10 from the giver. All these kind of things were captured in the dastavej to establish the claim of the giver on the borrower, and also handles the borrower grievances. Like suppose when the rupees 10 was granted to the borrower, the interest rate was 2.5%. Okay. But after some time, just an example, after some time the giver said, you have to pay 5% interest. So in this scenario, how will the borrower prove that the interest was 2.5%? By the using of dastavejes, right? That was a time, that was a thing during the medieval periods. Now let's have a look on the hundis and shroffs. So basically you can say hundis are medieval version of Adesh. All right. So this is also a type of bills of exchange. Okay. It means that it is for the business persons. One party is the BP, one party is the BR. All right. The BP is the person who is required to pay the amount to the BR, and BR is the person who is to receive the amount from the BP. All right. So this kind of thing in the medieval time period is known as the hundi. All right. And shroffs were basically the issuers of bills. Okay. And you can say they are also the person who in charge of the money lending activities. Okay. So if this person wants to purchase something from this person and he do not have that kind of money, then what he will do? He will reach the shroff, then shroff will make the bills and give it to the BR. On bills, the things will mention when the BP will pay the amount to the BR. All right. And if we talk about the today's term, then basically this bills payable system is controlled by the Negotiable Instrument Act 1881. All right. So in today's term, this entire process is controlled by the Negotiable Instrument Act 1881. All right. And basically, we could divide Indian history, banking history, into two phases. Pre-independence phases, which is start from 1770 to the 1947. Okay. And second one is post-independence phases. 1947 to the 1969. Why I'm telling 1969? Because from 1947 to the 1969, it's a period of pre-nationalization. Then it's a period of nationalization, and from 1991 to till today is the period of liberalization. Okay, so this is the division of history. And basically, if we talk about the banking in proper sense, so however the banking activities were started from the ancient time, but the pure banking was started from the 1770. All right, and how we will have a discussion over it. So students, basically in this lecture, this is enough, okay, for the starting of the history. In the next lecture, we will continue with the same topic. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the next lecture. With this note, let's end this lecture and thank you.